Welcome to the Stock Market Palantir. Today we are going to talk about KITT. KITT, or Nauticus Robotics, presents one of the most volatile and, frankly, perplexing situations in the microcap space right now. We are dealing with an extreme paradox. On one hand, you have a firm that's achieving genuinely critical technological milestones. Validated deep water autonomy for inspection, maintenance, down to 2,300 meters.
Yeah.
And yet, on the other hand, it's simultaneously facing, imminent liquidity failure and a governance crisis that is throttling its very survival.
And that dichotomy is what creates the wild price action we've been seeing. The stock's hovering around 72 cents, but it's punctuated by these dramatic swings. You had a plus 13, almost 14% spike on November 21st, and then a rapid, minus 14% drop just a few days before that. But what really defines the market structure here, and I think this gets to our central disagreement, is the trading anomaly. Over 50% of the recent volume, spiking up to 55% on November 28th, is being done off exchange in dark pools. That is not typical small cap behavior.
Absolutely not. That unusual volume dynamic suggests institutional forces are at play, either absorbing retail demand or internalizing distribution. It makes the mechanics really murky. So today, we're really going to analyze which force is dominant here. Is KITT's extreme volatility driven by a structural, tactical opportunity, what I'm calling the float lock, where market structure temporarily outweighs the fundamentals?
Or, as I would argue, do the overwhelming existential risks of solvency and, frankly, imminent delisting make the equity fundamentally uninvestable, regardless of any temporary price mechanics? I come at this from a very different way. My position is that the historical damage and the current financial structure of Nauticus make the common equity a near-certain wipeout risk. The corporate vehicle is just structurally unsound. It's caught in a liquidity trap, and no amount of technical trading opportunity can solve that.
That's an interesting point, though. I would frame it around the regulatory constraint. I see KITT right now purely as a high-stakes, asymmetric tactical opportunity that's been created by market mechanics. My whole thesis hinges on that failed shareholder vote on November 21st. When shareholders rejected Proposal 3, the increase in authorized shares, they, maybe inadvertently, created a critical, temporary supply constraint, the float lock.
Right.
This legal restriction effectively shuts down management's primary ability to tap their dilution mechanism.
And that dilution mechanism, we should probably clarify for the audience, is...
Exactly. We are talking about the massive $250 million equity line of credit, the ELOC, which basically functions as a corporate ATM card. It lets the company continuously print and sell shares to raise cash. Blocking that caps the supply side of the stock immediately. Now, you combine this float lock with short interest around 9.2% and a hard-to-borrow cost, or a CTB rate, that recently spiked to a max fee of almost 37%.
Which is a huge signal.
It's a huge signal that brokers are struggling to find shares to lend. So if any positive catalyst materializes, and quickly, let's say a major defense contract, fueled by that broader Trump robotics macro narrative,
Which, just to clarify, is the speculative idea that, a big ramp up in domestic defense spending, especially for undersea tech, will funnel huge contracts to firms like Nauticus.
Precisely. If that kind of news hits while this float lock is active, the supply constraint and that high borrow cost could lead to a disproportionate, and I mean violent, short squeeze. Market makers just can't hedge easily or flood the market with new shares from the ELOC.
I'm sorry, but I just don't buy that the tactical opportunity of a closed valve negates the underlying structural corrosion. You're asking investors to ignore why the valve is closed in the first place. It's because of shareholder dissent related to its destructive capital history. We've seen a cumulative 1-for-324 reverse split ratio in just over a year. Let that sink in for a moment. A long-term investor who held 1,000 shares in early 2024 now holds roughly 3 shares.
That number is staggering, and it absolutely speaks to the pain shareholders have endured.
It's near total capital destruction. This is what fuels that intense shareholder fatigue, the whole dilution scam narrative you see online. The failure of Proposal 3, which needed almost 3 million for votes and only got 1.5 million, was a clear vote of no confidence. So this isn't some boon for speculators. It's an existential threat. The company now legally cannot access its crucial liquidity source, which directly accelerates its path to insolvency.
Okay, let's focus on that governance failure, because this is exactly where the liquidity risk and the trading opportunity meet.
The failure to authorize more shares means the company is paralyzed. Their ability to fund their operational cash burn, which was a $6.6 million net loss last quarter against minimal revenue, it relies entirely on these equity financing mechanisms. Without that funding source, those 2,300-meter deep water tests are frankly irrelevant. Operational progress is meaningless if the vehicle itself is running out of gas. Chapter 11 or a distressed asset sale becomes the highly likely near-term outcome.
I acknowledge the massive solvency risk. It is absolutely the primary fundamental factor. But I look at that governance failure as a radical, almost unintended market intervention. It's like management accidentally sealed the relief valve on a pressure cooker. The company is, of course, now frantically forced to seek Plan B options. They could pursue what's known as preferred stock engineering, which is a highly technical move to create, future hidden dilution. Or they have to pursue a costly resolicitation for a new special meeting.
Which takes weeks or months they might not have.
Exactly. And until one of those Plan B options is successfully enacted, the float lock is a quantifiable market reality. And the evidence supports it. The spiking CTB rates, hitting nearly 37%, confirm that the inventory of shares available to lend is critically low. This raises the probability of delivery failures and, yes, a mechanical short squeeze if sudden demand spikes, because market makers can't just go buy from the company via the ELOC anymore.
But is the temporary removal of the dilution valve truly a tradable event? I mean, the inevitability of the company needing cash means they either file Chapter 11 or they fix the governance problem, which forces dilution through some other channel. You are staking your whole position on this narrow window where management fails to act quickly enough and a massive contract lands simultaneously. That seems like an irrational bet.
I see it as betting on structural inertia meeting a temporary supply choke point. And to understand the potential demand side, let's go back to the market microstructure. We both noted that extremely high off-exchange volume, above 50%. My reading of this is that it suggests strong internalization of retail demand. Retail traders, they're drawn in by this perceived opportunity of the float lock and the macro Trump trade catalyst, and they're actively buying the dip. This buying interest is just being absorbed by market makers who are routing sell orders, maybe from pre-vote ATM activity, through dark pools to minimize the price impact. It signals growing speculative demand being managed away from the tape.
See, I come at that dark pool data from a completely different direction, and for me, it reinforces my fundamental thesis. I believe that high off-exchange activity is far more likely evidence of heavy institutional distribution, primarily through the at-the-market or ATM offering that was in place before the vote.
Explain that distinction for our listeners.
Well, the ATM lets the company sell shares incrementally into the market. The whole purpose of routing those sales through dark pools is specifically to unload inventory and raise the cash they need to cover that $6.6 million net loss without crashing the visible bid price on the NASDAQ. If management is quietly using every available funding path through dark pools, it just reinforces the dilution scam thesis. The company is surviving purely on cash raised from ongoing shareholder dilution, not from their announced 400% revenue growth.
The revenue growth, while it's a positive sign of product fit, is clearly only offsetting a fraction of the operating cash burn. We can agree there.
And we have to emphasize the psychological and mathematical wall that's been created by those reverse splits. That cumulative 1 for 324 factor means the remaining float carries this permanent psychological overhead supply. Every single time the stock tries to rally over, say, $1, all those people who bought in before the splits are just waiting for an exit. It creates immense, invisible selling pressure that dark pool distribution just facilitates quietly.
That overhead supply is a major obstacle, no doubt. But let's look at the operational progress versus the regulatory cliff, because the operational side is the only theoretical path to what I call the great escape scenario.
The regulatory cliff is immediate and it's highly restrictive. The company is currently under a NASDAQ discretionary panel monitor. That gives them some time, but the requirement is absolute. To regain compliance on the market value of listed securities, the MVLS, they need to maintain a market cap that means trading above $2.55 per share. At 72 cents, they are miles away from that goal. The technological success, the Sea-Trepid acquisition, the Deepwater test, it doesn't provide the immediate, massive cash flow needed to bridge that $35 million market cap gap. It just provides a better asset to liquidate in bankruptcy.
That's a compelling argument to frame the technology as a liquidation asset. But have you considered that the Q3 operational pivot is the only lever management can possibly pull to overcome this financial chasm? The 400% revenue increase and the successful validation of their toolkit software on third-party ROVs, that proves the strategic shift from, CapEx-heavy R&D to an asset-light software and services model is commercially viable. Their recent move of the Aquanaut to a specialized Florida testing facility strongly suggests they are actively courting major defense customers.
But the timing has to be perfect.
The timing is everything. If the company can announce a substantial defense contract, that catalyst is powerful enough to spike the stock above that 255 NASDAQ requirement. And critically, that price spike would trigger the forced conversion of existing warrants.
And this is a mechanism that we should probably clarify. How does a warrant conversion solve the solvency crisis?
Well, a warrant lets the holder buy a share at a fixed price, the exercise price. So when the stock price spikes far above that, the warrant holders convert them into shares and they pay the company the cash exercise price. That transaction provides an immediate, non-dilutive, or rather already accounted for, cash infusion to the company. It potentially solves both the MVLS compliance issue and the immediate solvency crisis at the same time. It is the bull case, scenario C, and the float lock just amplifies the market reaction to that news because of the supply squeeze.
It is scenario C. It's the needle in the haystack outcome that requires near-perfect execution while their funding is legally broken. And while I'll acknowledge the minor signal of confidence from insider buying, William Flores buying, $8,900 worth of shares, that money is a rounding error compared to the tens of millions they need. You're asking investors to bet on the least likely outcome.
But the speculative opportunity doesn't require long-term viability, just short-term volatility amplified by market structure. I think the structural constraint of the float lock has created this unique, high-stakes tactical trading environment driven by that temporarily constrained supply and elevated short interest. While the fundamental risks are extreme, the mechanics offer a window for a speculative, high-volatility opportunity, provided that operational catalyst materializes quickly.
I just come at it from a different way. The financial structure of Nauticus Robotics is fundamentally, and I would say irreparably fractured. It's dominated by the cumulative impact of that dilution and the immediate legal paralysis of capital access. The technological progress is commendable, sure, but it's trapped within a corporate vehicle facing imminent delisting and insolvency. That makes the equity uninvestable on any responsible risk-adjusted metric. The short-term structural anomaly you highlight is simply outweighed by the near certainty of a shareholder wipeout.
Well, we certainly agree on the severity and complexity of the risk involved. The dynamic created by the float lock is a fascinating study in unintended market consequences.
And the critical watch item remains management's next move. If they file regulatory paperwork announcing a new special meeting to revote on the authorized share increase, that anticipation of renewed dilution will likely pressure the stock downward immediately.
Conversely, failing to announce that meeting or delaying it too long just raises the immediate bankruptcy risk, which would validate the bearish case. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.